Hey, I got a raise today. When's the last time you had a raise? I'm excited about this because I don't actually have a job. So me earning money is a big thing, right? I earn money through dividend growth investing. I did a video the other day and someone asked me, how are you getting a raise when you don't actually have a job? Well, I'm going to show you how. There's different ways to earn money. I want to compare two paths to financial growth. One, from getting a raise from your earned income job. Two, from getting passive income from dividend growth paying companies. I'm Dee from Brown Girls Invest 2. Welcome to my channel. Which one of those is going to be a better fit for you in building wealth? I've got 3 points that I want to cover. Let's find out what works best for you. Point number 1, earning a raise at your job. Let's talk about the traditional route of earning a raise at your job. When you go to work at your job, you are trading your time for money. This is what most of us are familiar with. You work hard, put in those long hours, meet the needs of the business, and hopefully you get rewarded with a salary increase. Here's the thing, the average annual raise in the United States hovers around 3%. So if you're earning the average U.S. income of $60,000 a year, a 3% raise would amount to $1,800. Now that's not too shabby, right? This is a chart showing the average salary of $60,000 with a percentage increase of 3%. That would take you to an annual salary of $61,800. And this is a breakdown also to show you how much you would get per hour, per week, per month. However, I don't want to be the bearer of bad news, but there is a downside. Inflation normally averages around 2% per year. The most recent data as of July has it averaging 3.2%. Now we're going to be nice and just use 2% for this example. So if you got a raise of 3%, but inflation is 2%, what that means is that the real wage growth after inflation is only a 1% gain. What that means further is that your wages are not keeping up with the rate of inflation. Now, it's great to see that bump up in salary. It just might not be enough to truly accelerate your wealth building journey. Point number 2, earning passive income through dividend growth investing. Now, let's shift our focus to dividend growth investing. The first main point here is the power of compounding. When companies pay you dividends, they pay you on top of those dividends the next quarter and the next quarter. Many dividend growth companies not only pay dividends, but also increase them annually. These dividend hikes can be substantial. On average, some of the top dividend growth companies have been increasing their dividends at a rate of 8 to 10% per year. And the really strong dividend paying companies that are categorized as dividend kings, those are companies that have been increasing their dividends for over 50 consecutive years. Dividend aristocrats from the S&P 500 have been increasing their dividends for a 25-year time frame. There's also dividend champions and dividend contenders. Here's a list of some of the dividend kings and their one-year annual growth rates. For example, Lowe's has a 16.22% compound annual growth rate. One of the companies I covered in my last video, PepsiCo, has a 9.28% growth rate. When companies raise their dividends each year and send them to you, they are essentially giving you a raise without you having to do anything but own shares in that company. So imagine you invest in a dividend stock with a 3% yield and the company increases its dividend by 8% annually. Over time, your yield on cost, that's the initial yield you receive on your initial investment, that grows significantly. In fact, it can double in about 9 years and quadruple in about 18 years. That's the magic of compounding growth. The second point in favor of dividend growth investing is the snowball effect. As your investments grow, the dividends they generate grow as well. What this means is that your money is making money. You don't have to work for it. You've already done the hard part. This can lead to an ever-increasing stream of passive income without you having to work harder or put in extra hours. It's like having a money-making machine that works for you while you sleep. Speaking of making money while you sleep, let me tell you what my Uncle Buffy said. If you don't find a way to make money while you sleep, you'll be working until the day you die. Let me tell you what else Uncle Buffy said. He said to like and subscribe to my channel and turn the notification bell on so that you receive more information just like this. Now let's get back to these dividends. So when comparing a 3% annual raise at your job to the potential for a double-digit dividend growth and the snowball effect in dividend investing, it's clear that passive income from dividend growth companies can be a game changer for your financial future. Now, getting a raise from your earned income job and investing in dividend growth companies both have their own strengths. But if you're looking for a more accelerated path to financial freedom, dividend growth investing can offer you the potential for higher income growth and the power of compounding on your side. Remember, it's not about choosing one over the other, but finding the right balance that suits your financial goals. As always, do your own research, consider what is best for you, invest well, and let's give ourselves a raise. Okay, that's it for today's video. I hope you found it helpful. Do me a favor, leave me some comments. Let me know, are you receiving any passive dividend income? Did you recently get a raise? Do you have a nice mix of both? Whatever the case, let's continue the conversation. Thank you again for watching. I hope you come back and see me, and I'll catch you in the next video.